Good morning, everybody. Paul here coming at you with a crypto coffee update where we talk about all of the exciting news, happenings, and events in the exciting world of digital finance, colloquially known in our neck of the woods as crypto. So let's go ahead and examine what we have on the menu for today, right after our shared simultaneous sip, a sip of solidarity to start the episode right together. Cheers. Awesome stuff. All right, so you might have already read the title. We have exciting news coming at you from the SEC, some issued guidance. Kind of. It's a statement on the framework for investment contract analysis of digital assets, straight from the SEC. You can see here Bill Hinman, the director of the Division of Corporate Finance, and Valerie Sizikzipanek. I hope I did you justice, Valerie. If not, I apologize. Probably the hardest last name I've had to pronounce here on the Crypto Coffee videos so far. But nonetheless, these two individuals have issued a type of guidance for how investment contracts function as in respect to digital assets. This primarily focuses on what's known as the Howey test, something that the SEC has driven home just intensely over the last few years. So what is the Howey test? The Howey test is a part of the 1933 Securities Act and 1934 Securities Exchange Act, and it pertains to one W.J. Howey. W.J. Howey and Company wanted to sell some land in the south of Florida, a citrus plantation, in order to finance the expansion of said plantation. You can see here that the individuals who purchased the shares of the land had no knowledge, skill, and equipment necessary for the care and cultivation of citrus trees. Not only that they purchased the land based on the assumption that it would generate a profit for them as a result of the efforts of somebody else. This is the classic test now applied to almost all issued assets to ascertain whether or not these issued assets qualify as a security in the eyes of the SEC. This is something that's been shouted from the rooftops, as said, over the last couple of years, and now that we have a little bit more information as to how the Howey test may specifically apply to issued digital assets, it's going to be very interesting, especially because, as you can see, this is going on 80-something years old in terms of age as a test, long before computers were even thought to be relevant to daily life. So consider the fact that now digital assets present in their own right a myriad of opaque implications as to how these existing tools may apply to them. Having the SEC take action is really encouraging to see. Here is the act itself. And the first thing I want to point out is the fact that this has a footnote in the title. Let's scroll down and take a look at exactly what that says. And I'll explain how I was able to figure that out here momentarily. It was not by my own eyes that I noticed that footnote. I'm almost ashamed to say, I try to be as scrutinous as possible, but a footnote in the title, that's some interesting stuff. So this framework represents the view of the strategic hub for for innovation and financial technology, the FinHub, the staff, or we, of the Securities and Exchange Commission, the Commission. It is not a rule, regulation, or statement of the Commission, and the Commission has neither approved nor disapproved its content. Further, this framework does not replace or supersede existing case law, legal requirements, or statements of guidance from the Commission or staff. Rather, the framework provides additional guidance in the areas that the Commission or staff has previously addressed. Now, essentially what this means, I look to Dr. Stephen Pally. He is I believe he's a doctor. If you have a law degree, are you a doctor, or are you just considered like lawyer? I guess you don't have PhD. I don't know. These titles get complicated, but he is a very insightful lawyer. I don't think he needs any three-letter things ticked onto his name to show that he stands on his own right. But essentially, this is the gentleman that pointed that out. He says, if I'm being honest here, I'll confess that I've written things that have footnoted titles myself, and it reads a lot like a law firm memorandum. And he also reads the footnotes first. Before we get any more into Mr. Pally's fantastic analysis, here is his Twitter. I just wanted to show that off so that you too can continue to build your own robust Twitter following of very intelligent individuals in the digital asset space, so that you can, on your own, gauge what they're doing, what they're looking at, and really embody the idea that if you want to go fast, go alone, but if you want to go far, go together. Truly, I know for a fact I stand on the shoulders of giants, whole fields of them, because there are some great minds out there. Mr. Pally definitely showing himself to be one of them with this great analysis. Essentially, The framework can be summarized as follows, as you can see here from his article. If you want to do an ICO, you got to be mindful of securities law. That should be, I don't want to say a no-brainer, but definitely something you want to keep on the forefront of your mind. Digital assets in the form of blockchain, token-y things are analyzed here by considering whether they have characteristics of an investment contract. And you can tell if something is an investment contract by applying the Supreme Court's Howey test. There it is again. And cases that follow it, which find an investment contract exist where there is the investment of money in a common enterprise with a reasonable expectation of profits to be derived from the efforts of others. Again, moving back up, you can see here, this is ultimately just clarification. You can see they cite the Howey test, and according to Mr. Paley, the SEC wrote you a memo because you kept bugging us. Now go hire a lawyer and stop screwing around. We mean it this time. In fairness, even though it's legally speaking nothing in terms of precedent, you can be sure it'll be cited in briefs, and courts will end up citing it in opinions, so it's not exactly a non-event. So even though this is not necessarily something that's binding, it's not really official, it really is something that still offers a more robust form of clarification explicitly for digital assets. As said previously, digital assets after their introduction have created a collection of opaque potential implications, so having at least something to stand on, especially something that in the eyes of a lawyer will ultimately be something that may be cited in court briefs, means that this is at least a step in the right direction, perhaps. Moving along, there's something in the other relevant consideration section. The stronger these factors are, the less likely that you meet the Howey test, meaning that no security. So if the network and assets are fully developed and operational, then ultimately that lowers the likelihood that you've issued a security. You can use it right away, meaning that there's no future development in between the time of the issuance and sale and the time when you can use what you purchased. The asset is built to be used, not for speculation. That's a big one. We use the term utility token, but that's not necessarily legally defined per se as of yet, at least insofar as I understand it. Prospects for appreciation and value are limited. You can actually buy stuff if it's a virtual currency. That's a big piece of the puzzle. If you can issue a virtual currency, but if you can't actually use it as a currency, well, that could kind of dampen the prospects of it being what it says it is. Economic benefit and appreciation is incidental to value, essentially meaning that the functionality of the token comes first and foremost. Not even the token, the digital asset comes first and foremost, and any monetary appreciation is simply incidental with respect to its actual application. Marketing emphasizes functionality of asset, not its speculative value. That's a big one. Restrictions on transfer of assets are consistent with use, not to create speculative value. Restrictions on transfers of assets are consistent with use, not to create speculative value. Think cryptocurrency exchanges and what proportion of the total liquid supply is available on exchanges versus within the actual wallets being used on active networks. This could offer some really interesting considerations and insights to existing projects. And of course, secondary market transfers, if any, limited to users of the platform. So these last 2 points, taken in conjunction with one another, paints a very potentially slippery picture for assets that have been issued that have a disproportionate amount of their active available liquidity on exchanges. So really interesting things, a lot of potential implications here. And here we have some even more information from something called Turnkey Jet, which is a company that essentially just offered a rewards program and stuffed it on a blockchain for some reason. Not sure exactly why, but the SEC came out and said, look, basically if you abide by really a summation of these points above, then it won't be a problem and we won't consider this a security. So the TKJ token is kind of a weird case. We're not going to beat this to death here, so you can go ahead and head to the article. Of course, everything's cited below in the description, guys. Citing your sources is so important out there, especially in the world of fake news. That's certainly not what this is, because it's straight from the horse's mouth in terms of the SEC, and Mr. Paley did a fantastic job breaking this down. So if you're interested also in the issue of non-action from the TKJ token, you can check it out here. Once again, Mr. Paley's Twitter, I'll link that below again in the description. And one more piece of funny information. The SEC's new crypto guidance short version, this is Howey. Do it. pretty much the grand summation of everything we saw here. Again, not really a complete nothing, but nothing that is concrete. Really not the big blowout sale excitement we expected, but still something good to see. Had a lot of fanfare and was really fun to read over. Perhaps it will serve as a great tool to help individuals who are issuing digital assets better understand what Howey is and why they need to really actively consult their legal counsel about it. So, moving on, Bitcoin's price has boosted Grayscale's digital asset fund to over $1 billion. So, for those of you who don't know who Grayscale is, they are a fund that invests in not only Bitcoin, but various assets, creating portfolios to hopefully profit very heavily off of the swings in the crypto markets, run by none other than Barry Silbert, a bright mind in the crypto space with respect to these kinds of funds. So it pushed their AUM, their assets under management, above $1 billion. What a difference a day makes indeed. With 15% jump in Bitcoin just a few days ago, you recall in the last Crypto Coffee update, things are moving along. Very interesting stuff to see, and of course exciting to see crypto-denominated entities essentially boosting their assets under management. Really awesome stuff. Next up, not so awesome. Well, I don't know. It depends on where you fall on the scale of use of authority. I, for one, think this is like kind of scary. Coinbase CEO wants to overthrow corrupt dictators after hiring team that sold spyware to corrupt dictators, and that's headlines you only see in crypto, right? You have young Lex Luthor looking guy here talking about overthrowing dictators after hiring the teams that installed them. Just strange stuff, I'm telling you. But essentially, yeah, it's 36 minutes and 36 seconds to see the segment in which Brian Armstrong said this. I don't think Brian's a bad guy, and frankly, if you know that a dictator is intrinsically corrupt, then having the desire to remove that corruption and instill some kind of harmony is ultimately from a good place. But they say that the road to hell is paved with good intentions. Not saying that's the road that Coinbase by any means, and of course Brian Armstrong are on, but definitely it strikes one as strange because it begs the question: how do you define corrupt? How do you define dictator? And in what way is interfering with politics using financial authority something to be admired as a cool ultimate goal? Really, as I said, it's something that strikes me as a bit strange and perhaps a bit scary that this level of authority can be thrown around with perhaps such disregard for representative Republican politics, democracy. I almost said democracy, but really the United States is a constitutional republic. So just weird stuff. This has really gotten me kind of thinking about how these entities will conduct themselves in a future where ultimately these crypto assets have wild amounts of value in human society, and how the individuals such as Brian Armstrong have positioned themselves, how they will use this newfound financial authority to ultimately impact political authority. So just really interesting considerations. As said, I don't think Brian Armstrong's a bad guy per se, but I did hear something funny on Twitter. I don't believe this. He's like, never trust a young guy who makes himself bald on purpose. But just a little hair humor there. I know I need a haircut, but yeah, so with that said, Coinbase CEO wants to overthrow political people. Crazy stuff. All right, billionaire Brock Pierce, moving on to other billionaires. This gentleman, he was involved first by creating RealCoin, which became Tether, was ultimately involved as well with EOS. So this gentleman has positioned himself quite well. He was involved with Mt. Gox as well. Can't forget that. A lot of drama surrounding that, considering the Mt. Gox saga wrapped up relatively recently. But this gentleman has decided to create a Bitcoin as collateral-backed loan for his mortgage. Apparently the first in the world to do so. So very interesting stuff there. Now, some people are speculating perhaps he's fallen on hard times, but there may be a bit more financially savvy methodology for doing this. You can see here, where is it at? It appears the reason Pierce sought a Bitcoin-backed mortgage for the home is more than just more one of financial astuteness than necessity. Essentially, hodlers, as they're called, they don't want to sell their assets. They're convinced a bull run will come eventually. So ultimately, by collateralizing their loan in Bitcoin, the appreciation of the underlying asset will hopefully offset some of the potential underlying I'm trying to say here, the collateral that they've locked up. So hopefully the dollar appreciation will ultimately mean that he has to spend less Bitcoin over the long run. So that's kind of the logic there. You can see here, he backed an entire loan for a house with Bitcoin, first ever crypto-backed mortgage. Assumingly, other individuals who settle for property on the blockchain are either doing it in a stable coin, such as Tether, or maybe a more above-board regulated one. But as well, it seems this is the first time someone has used entirely Bitcoin for their mortgage. So really cool stuff. Brock Pierce definitely is an innovator in terms of blazing new trails, and not only in the crypto space, but in the digital world in general. I mean, before he got to start in crypto, he was selling online. He created a marketplace for selling online goods, assumingly, I think it was for World of Warcraft. It might have been EverQuest, but nonetheless, really cool guy, at least from the surface. I'm sure he has some interesting stories and interrelations, especially with all the history he has in space. So interesting. Next up, we have a analysis of BlockFi. In the previous article, actually, BlockFi was mentioned in passing, I believe. Not going to spend time. No, it's Block 1. Yeah, nope. Yeah, okay, so BlockFi. This is an analysis from Zaim Pakok about BlockFi, and it breaks down kind of ultimately what the terms of service say and some of the considerations. We're not going to go over all of this. I'm just going to look at the main points. I'm going to Control F. Boom, there it is. Haha, I love the Control F function. We need one for real life. That would be amazing. Augmented reality glasses, please. Can't come soon enough. All right, the short thesis for investing in a BlockFi interest account is to earn interest against the risk of BlockFi defaulting. So essentially, these are like high-risk junk bonds and not savings account, which culturally carry a lot of low-risk assumptions. So this is incredibly important to consider, the fact that these are like high-risk junk bonds that run the risk of potential default with a much higher probability than something like a savings account. You may think of this as, oh, I'll put my money in here, it'll be safe, and I'll earn interest on it. Not the case. Really, you are financing the activities of BlockFi and assuming that they are taking on a level of risk that is within your risk tolerance. So definitely something to consider there. There's also the risk of rehypothecation, although it's not perhaps the most significant. It means the asset that you post as collateral against a loan is used in turn by the custodian as their own asset for a further loan. So essentially, receiving a loan and then using that as collateral for a further loan. As you can imagine, it's extremely risky. Rehypothecation is definitely a shaky thing at best. It's a fallacy that this phenomena even exists. I think Caitlin Long and myself would agree with that for sure. She's the individual who introduced me to rehypothecation, actually. Fascinating stuff, fascinating reads. There's free papers out there about it, so if you're interested in that kind of finance, it is just riveting to check out. A lot of that led to the 2008 financial crisis. But suffice to say, this can lead to issues of fractional reserving. The Mystery of Banking by Murray Rothbard explores some particularly pertinent stuff here. The traditional separation of roles from deposit banking and loan banking, and that seems to be something that is opaqued here as well. As I said, we're not going to go over this just for the sake of brevity, but definitely worth a read if you are considering trying to earn any kind of interest on your crypto. Understand that this is still an extremely high-risk setting. This is not a savings account for which you are guaranteed capital. It is definitely a risky venture, more like a high-risk junk bond. So you could check out either here on Twitter or here on Medium, Zaim Pakok's fantastically written article. I mean, really, like I said, shoulders of giants, folks. There are some ingenious people out there who do just amazing analysis of this kind of stuff, and it is my pleasure to aggregate this kind of stuff and share it with you because it's all very relevant, and as said, it's all below in the description. All right, so one more piece to finish off our lovely time together today, something I always enjoy. Bitcoin searches have tripled during the last rally Google Trends show. So very interesting stuff. Prices jumping up. You can see in Baidu, hottest new keywords, Bitcoin, back on the block. And you can see Google Trends, sudden spike, almost running with, almost correlating perfectly with the spike in price. I was on Twitter actually not too long ago when I saw somebody say, no, it was LinkedIn, excuse me. I was on LinkedIn not too long ago and I saw someone say, you know, when your neighbor who you normally just talk about trash pickup and HOA stuff with asks you when you're taking out your trash, hey man, you see what Bitcoin did? Man, you think it can come back? You think it can keep going? Then it's definitely still in the public zeitgeist. It's still in the public mind. And to think that such a voracious 2017 bull run in which so many individuals received at least a surface level introduction to the fact that these things exist, well, that would go away after only 2 years. Oh, I mean, people do have a bit of a short attention span, myself included. There are all kinds of shiny and interesting things out there, but this is really a revolutionary thing. When you see an entire new asset class emerge before your very eyes, people tend to remember, even if they only remember just a bit of the basics. So with that said, who knows where this is going to lead us? Who has any idea what this mysterious 20,000 Bitcoin order was for, and who ultimately executed it? But suffice to say, it elicited much fanfare from the eyes of individuals all around the world, perhaps even those who maybe chalked Bitcoin up to just being that 2017 thing. Perhaps they're back in the fray. But with that said, check out the Howey test, guys. Check out the SEC framework. Super important stuff. And you want to look at the Howey test if you're even thinking about potentially offering a digital asset. And as said, check out Stephen Pally. Big shout out for him today. He really helped to carry the information in this episode, offering a beautiful summary of the entire SEC breakdown. And another shout out to Zane Pocock for his fantastic analysis of BlockFi's terms of service, helping to keep us all just conscious of what we're doing with our crypto. After all, with great power, financial power specifically, comes great individual responsibility, and really is fantastic to see individuals striving for that in the crypto space. So with that said, thanks so much for spending some time with me today, folks. It is always my pleasure to be able to talk about this kind of information with you. If you have any questions, feel free to ask below in the comments, or hop over to the Discord where myself and Origami Oracle as well, the resident technical analyst, a very incestuous man, hangs out, and we always have great conversation there. So with that said, thanks again. My name is Paul. We are Cryptide, and remember, the tide is rising, just like the Bitcoin search trend.